In this video, we are going to discuss the strategy in detail, RSI Boom, which is a powerful momentum swing strategy that captures large moves quickly. So as I said, this is essentially a swing trading strategy, which means that the trades can last from few hours to few days. And this is primarily a long only strategy, which means it should be used only for buying stocks or going long. It can be used for shorting as well, but you have to backtest it and see for yourself whether this works on a particular asset or not. In generally, I do not use this particular strategy for short selling and I don't recommend it. But if you have encouraging backtest results, you can definitely give it a try. And this is a pure momentum strategy where we try to take an entry right when we see first signs of strong momentum. As for exits, we use EMA for exits. And for this particular strategy, RSI Boom, we use 1 hour time frame. And indicator setup is very simple. We use just two indicators, RSI, Relative Strength Index, and the period that we use for RSI is 10 period. Standard or the default that is used in RSI is typically 14, but for this particular strategy we use a shorter period so we can identify the momentum, the beginning of momentum move early. And then we also modify the upper range and lower range of RSI, which are also typically known as overbought and oversold levels. And we use these levels as 65 and 35. By default, these are 70 and 30 respectively. Some people even use 80 and 20. But for this particular strategy, we use 65 as the upper level and 35 as the lower level. EMA that we use is 34 period, that is used for exit. We also use another period EMA, 55 period, that is basically for filtering the trend. Like any other strategy, this strategy also requires that the selection of stocks is suitable for this particular kind of setup. A lot of people fail in trading not because they have a bad strategy, they just don't know which kind of assets or which kind of stocks they should be trading with that particular strategy. Not all strategies work on all kind of stocks, right? For example, this is a momentum strategy, and momentum strategy typically works on, mid caps, small caps, even micro caps. Large caps, it's not a suitable strategy because large caps do not really move much. They will give you like 2%, 3% kind of move. On a very good day, they might give you 5%, but you won't really get 10%, 15%, 20%, and those kind of moves in large caps, right? Similarly, for mean reversion setups, large caps are good because they don't really move much, and smaller cap like mid caps, small caps, they may not really be good candidates for mean reversion kind of trades, right? So basically the point is you have to be very selective about the stocks depending on the underlying strategy, the strategy that you are going to trade. So for this particular setup, this is the criteria that you have to be mindful of. First thing, beta. So what exactly is beta? Beta basically tells you how volatile the stock is compared to the benchmark or the index. So for example, if I talk about India, we have Nifty 50 index, or if we talk about US, we have S&P 500, right? So compared to the index, how much the stock moves. For example, on a given day, if index moves 10%, obviously that's not what happens. Normally, no index moves 10% in a day. But let's say if it happens and the stock also moves 10% on the same day, that means we say beta is 1 because they are at par. They are moving in line with each other. But let's say if the index moves 10% and the stock moves 15%, 1.5 times. So then we say beta of the stock is 1.5 because it is moving 1.5 times more than the underlying index or the benchmark. Similarly, if the index moves 10% and the stock moves just 5%, then we say the beta of the stock is 0.5 because it moved just half of what the index moved, right? So for this particular strategy, we need high beta stocks, basically the stocks which are more volatile than the index, but we don't really need a very high number to begin with. 1.2 based on the back test that I have, 1.2 is a good number, and stocks having 1.2 or higher beta are ideal candidate for this particular strategy. Second thing, market cap. Market cap of the stocks in Indian context, it should be somewhere in 500 to 15,000 crores, and a US equivalent for this would be 250 to 7500 million USD. So this should be the market cap for this strategy. And then 30-day average turnover. What exactly is turnover? Turnover is basically the value of the stocks traded in a given time frame or even in a given day, right? So in this particular case, we are saying 30-day average turnover, basically, which is price multiplied by the volume. So in Indian context, 30-day average turnover should be at least 50 crores. And if you are talking about US markets, you can go with a higher number like 100 million US dollar at a minimum. And then price should be above 55 period EMA for the long setups. And this is about trend filter. And finally, you have to avoid large caps and penny stocks. Large caps because, as I was saying, they are not suitable for momentum trading because they don't usually move much, right? And penny stocks because they are too volatile for any strategy, including a momentum one. They will be stuck in, circuits sometimes, and it won't be possible to get out of those stocks if they go against you. So you have to avoid these kind of stocks, large caps and penny stocks. I have obviously tested this strategy in Indian market, and the criteria of these figures like beta, market cap, 30-day average turnover, that is based on my experiences in the Indian market. I haven't really tested it in US market, but I believe the similar kind of setup, similar kind of figures, as I have also put in the slides in the USD, they should work well, maybe with a little bit of tweaking, and the strategy should work with this kind of stock selection in other markets as well. So finally, we come to the entry criteria. Now that we know what indicators we are going to use and what are the stocks that we are going to trade, we have to understand how exactly we are going to take entry. First thing, price must be above 55 period EMA. We take an entry when 10 period RSI on hourly time frame crosses above 65 on a candle closing basis. Candle closing basis means we wait for the candle to close to verify if the RSI has crossed above 65. Sometimes what happens is you see that RSI has crossed above 65 and the candle is still forming and you take in trade. But by the time the candle closes, the price has dropped and the RSI has also come below 65. So that's not what we want. We want that once the candle has closed, the RSI should also have closed above 65 value. So basically that's what it means. We have to wait for the candle close and confirm that the RSI value is above 65. So that's all. I mean, that's the only entry criteria that we use. And if you are thinking it is way too simple, then you know it, keep it simple, stupid. So you can judge for yourself when I'm going to share the strategy script that you can import in TradingView, and you can backtest it against number of stocks as per the stock selection criteria, and you can see the result for yourself. Key for this strategy, like any other strategy, is choosing the right kind of assets. In this case, stocks, it works best on mid caps, small caps, and even micro caps. But large caps should not really be used for this particular strategy. Exit criteria is also as simple as the entry criteria. We exit the trade as soon as the price closes below 34 period EMA. Risk management, very important. In this strategy, we do not risk more than 1 to 2% of the trading capital per trade, right? So for example, if you have a trading capital of 100K, 100,000, 1 lakh, for example, in Indian context, then you should not risk more than 1,000 on a single trade, maybe 2,000 if you are too confident, feeling good about it, and you have had some positive results in the last few trades. So you know the market is working in your favor, right? But generally speaking, 1%, maybe maximum to 2% is what you should risk, not more than that. And when we take a trade, we put a protective SL just below the entry candle, the candle which has given us RSI above 65, or if it is too big, then we can also place the SL right where we have 34 period EMA at that point of time. So any of those stops we can use. Important thing is we should ensure that the size of SL is never more than 5% of the stock price, right? If the SL is coming out to be bigger than 5%, then we should simply avoid that particular setup and look for another opportunity, right? Position sizing. So I said in the previous slide that you should not risk more than 1% of your capital, right? So how do you determine how many stocks you should buy? So this is the formula for determining how you can use the correct position sizing as per your risk management rules. So for example, if you have a capital of 100K, 100,000, and you want to risk not more than 1%, and for a particular setup, the stop loss is 5 points, right? So in that case, we will calculate the position size as 100,000, which is our capital, multiplied by risk percentage. Risk percentage is 1, and if you convert it, then it gives you 0.01, 1% divided by your stop loss size, that is 5 in this case, and that gives us 200. So in this particular case, you should buy 200 stocks, and if the SL hits, in worst case, you will not lose more than 1% of your capital, which is 1,000 in this particular case, right? Similarly, depending on the setup, you can and your capital, you can always calculate this amount and determine what should be the right position size for a particular trade. Now, this is something very important. This is the secret sauce for this particular strategy, and it can help you improve the win rate of this strategy drastically. And the secret sauce is market breadth. For this particular strategy, market breadth of 20 and 50-day SMA. So what exactly is market breadth? Market breadth represents percentage of stocks above given moving average, as we are saying 20 and 50 in this case. So above given moving average within an index. For example, index could be Nifty 500, it could be S&P 500. So if 20-day market breadth of Nifty 500 is 60%, then it means 60% of the stocks in Nifty 500 are above their 200-day moving average. And if 60% of the stocks are above their 220 period moving average, 20-day moving average, that means a lot of stocks are moving in the direction, in the up direction, right? So basically the winds are in your favor, and that improves the chances of your trade working drastically, because as I said, this is a long only strategy primarily, and we are going to take long trades. So if a lot of stocks, more than 50% of the stocks are moving in your favor, you have already improved the chances of your trade working, right? Best time to trade is when both 20 period and 50-day period market breadth are between 50% to 80%. So if the market breadth is less than 50%, that basically means less than half of the stocks are above their 20 or 50 period moving average, which is not really ideal. So market is not very strong. It's actually getting weaker, right? So at that time, if you take a trade, chances are it may not really work for you. So ideal range for this strategy, or in fact for any long swing strategy, is when 20 period and 50-day period market breadth is between 50 to 80%. You might ask, why not 100%? That's because when the market breadth crosses 80%, that's when historically you will notice that reversals form, So above 80%, this is basically kind of overbought zone, and reversals can happen. So above 80, it's not wise to take fresh positions. If you already have an existing trade running, it's fine. But above 80, it's not recommended that you take any fresh trades, right? And how you will find these market breadth numbers and the position sizing, the strategy, and everything else we are going to cover in detail in this course. So right now, this is all theoretical, and we are going to cover it in practical manner in the next few sessions. So that's all for this video. See you in the next one.